Hey, what's up, everyone? Welcome back to my world of stocks. We've got the last episode of the quarter for this series here, where we take a look at the five largest stocks that a famous large investor is buying. And what a great way to wrap up last quarter than to analyze what Vanguard is doing, as they are currently the second largest investment management company in the entire world, only behind BlackRock, with an estimated assets under management of over $8 trillion. That's more than the GDP of literally any country in the world that isn't named China or the United States of America. How crazy is that? Now, of course, Vanguard grew in popularity because of their various funds and ETFs that typically have low expense ratios and are very well liked by more passive minded investors that want to own a basket of many different stocks within a single fund or ETF rather than having to handpick each individual stock themselves, essentially trusting Vanguard to do most of the hard work for them and to pick great stocks to invest in. But as such, Vanguard has now grown into the largest issuer of bond funds. They're the second largest for ETFs, and they're the number one largest for mutual funds as well. So obviously at that gigantic size, they do have, some pretty large influence here over the stock market, depending on what the group chooses to buy and sell for their various funds. Well, as with any other giant institutional investor, the Vanguard Group is forced to disclose all of their trades every quarter to the SEC. And so, as always, we'll be running through the top five largest of those stock purchases. I'll give you my own opinion on each one of them, and I'll even rank them from best to worst too, just to make it a little more fun and interesting. So I hope you guys enjoy this video. Let's go ahead and jump straight into it. All right, now we'll be counting up here from smallest to largest position in the portfolio, and coming in at purchase number one, well, we've actually have a brand new addition to the portfolio here, and it's also a stock that I don't think I've ever talked about before on the channel, and that is Flutter Entertainment, ticker symbol FLUT, which Vanguard scooped up about 8 million new shares of last quarter, worth over $1.5 billion, and yet that's still only 0.03% of the entire pie. Super crazy, right? Anyway, if you've never heard of Flutter, they're actually an online gambling company, especially in sports betting, with even some gaming elements sprinkled throughout too, like casino games and other stuff like that. But yeah, overall, just a giant online gambling company with huge brands and platforms like FanDuel, PokerStars, and more, which they claim makes them the number one largest sports betting and iGaming operator in the world at over 12 million average monthly players last year. Now, as you probably know, online sports betting has been soaring in popularity recently, which has convinced many companies to expand into other areas of gambling as well, like in video games, casino games, and even politics. Like, you can literally bet on who you think will be a presidential nominee. It's pretty wild. And another great example of these expansions is also how DraftKings recently acquired Jackpocket for $750 million so that they can now sell lottery tickets as well. How crazy is that? Anyway, not all of these different elements are 100% legal in all parts of the world, but adoption has been greatly increasing over time. And as such, just sports betting alone reached $120 billion last year in America, which was nearly a 30% increase from the year before. And so because of all this growth, Flutter has seen staggering revenue growth in recent years. However, they are not yet profitable, which is usually the case with these type of companies that operate in very heavily saturated markets and thus have to spend most of their profits on advertising and various promos to get people onto their platforms over the competition. I mean, even Disney, which used to be known for being so family friendly, has even entered the gambling space too through ESPN Bet. And as a result of all of this saturation, Flutter's revenue growth is also expected to fall down now into the teens both this year and the next, which isn't a great sign, at least compared to what they used to put up. However, margins would be really good if it weren't for all of the advertising and promo spend, and that's why you see their forward PE ratio fall from 121% higher than the sector to a 5-year PEG ratio, more forward-looking outlook, that is actually 44% cheaper than the sector because of all of their expected growth on the bottom line that should be coming in the future. Now, time will tell if all of those costs do actually come down enough to make this a value stock here worth picking up. But at the moment, I just feel much safer with my investment in something like Disney, who now gives me a little bit of exposure to this market too through ESPN Bet, but is of course a much larger, more diversified company and isn't just relying on a heavily saturated gambling market. Anyway, I don't think Flutter is a bad stock, and even after rising recently, it'll likely keep climbing on any positive profit news, but I'm gonna rank it somewhere in the middle for now at number 3 until I see what else is on this list, because it is a pass for me. I'd prefer something like Disney. Moving on to purchase number 2, though, we actually have a dividend king in the pharmaceutical giant AbbVie, ticker symbol ABBV, which Vanguard scooped up another nearly 10 million shares, bringing the stake up to over $31 billion worth. Now, like I said, AbbVie is a dividend king in that they've now increased their dividend for over 5 decades in a row, which still yields 3.6% too. And that's always made AbbVie an attractive dividend stock among investors. In fact, I actually own the stock myself too. However, my yield is much higher because I bought it many years ago at some much lower prices, whereas today the stock has risen to almost a record high. Still, many investors continue to buy the stock today for several reasons. For one, again, that dividend is very attractive, but also because AbbVie has really shown to be a cash generating machine, growing their free cash flow from less than $17 billion in 2020 to more than $22 billion last year, and that's huge. Now, on the flip side, times have been getting more challenging with rising competition in a saturated pharmaceuticals market, as well as the patent loss of key drugs, including Humira, which was their number one best-selling drug. It was the number one best-selling drug in the world. And as such, that free cash flow actually declined by a couple billion last year, while revenue growth has also fallen to just a mid to low single digit rate, and the same goes for their EPS as well. And so moving forward, I think AbbVie should be looked at as a bit more of just like a strong cash generating dividend payer than something more like a growth type of stock. And by the way, I do feel that the cash will keep coming in. I mean, this is a company that spends many billions of dollars on R&D every year, which results in a lot of innovation, a lot of treatments that they can continue developing and putting out there in the market. They've got a massive pipeline, guys, of new drugs and treatments. It totals over 75, which is a lot larger than I've seen in a lot of other competitors. And I also think that will help them offset the current struggles and help them maintain their size and their balance and their dominance and their cash flow. And we're already seeing signs of this with, for example, Rinvoq and Skyrizi. Those two drugs alone are helping make up the losses of Humira as they continue to grow larger and larger over time. And AbbVie is also investing more heavily into genomic research, which I also think will play a huge role in the future of medicine too. And there's high hopes for that as well. And even the valuation isn't as bad as you might expect it to be given the rising stock price. I mean, you've got a forward PE ratio that is 20% cheaper than the sector. That's not too bad. Their PEG ratio is a little higher though, at 13% more expensive, which illustrates the lack of growth that I talked about. But for a giant leader like this to still be trading around these levels, I actually think that it's pretty reasonable overall. Anyway, it's definitely a stock that I plan to continue holding myself. But again, you have to keep in mind, I got in at much lower prices and have a much higher dividend yield. If I was a new investor into the stock, I wouldn't be buying it. I would actually prefer something else like Pfizer or Bristol Myers Squibb, who are also in pharmaceuticals, biotechs, but they have cheaper valuations and they have much higher dividend yields at the moment, like double the yields I think right now. So I would prefer that. But because I do already own the stock, I guess I have to rank it a little high. I'll give it the number 2 spot above Flutter, but again, I'm not buying any more myself. It's just a hold. That will, however, bring us now though to the third purchase of the list. And we have another stock here that I also own, and that is in Broadcom, ticker symbol AVGO, which Vanguard increased by another 3%, bringing the stake up to almost $60 billion and worth over 1% of the overall portfolio. Now, we actually covered Broadcom last week too as a stock that Steve Cohen is buying, so I'll keep this short and to the point here, but basically Broadcom has been rising a lot this year. That's thanks to strong earnings and especially their advancements in AI, which led to Bank of America even calling them their top 2 AI pick. How crazy is that? For their work in developing custom AI chips for business, saying that the company could even potentially join the Trillionaires Club in the future alongside other tech giants like Google, Amazon, Apple, Meta, Microsoft, and Nvidia. To which Goldman Sachs added that along with Nvidia, they see Broadcom as a critical piece to the ongoing AI infrastructure build-out. That's wild. On top of these positives though, Broadcom also recently split their stock, which usually leads to a boost as it's more easily accessible to smaller investors. And in total, the stock has now risen to a record high and is up over 2,300% over the past decade. And yet valuation wise, it's actually not super crazy, not as crazy as you would think it'd be. And that's thanks to their earnings growth, as their PEG ratio is only less than 10% higher than the sector. I do feel that the stock has already risen by too much for me though to be buying significantly more at these prices. But even here, I still think that you get a very solid business with strong financials, strong future promise in AI, cloud computing, cybersecurity, and other technologies on the heels of a fantastic acquisition of VMware. And you even get a nice little dividend too with some solid growth metrics on it. So I'll rank them at number 2. I'm going to push everything else down one spot to fit it in. All right, guys, we are now left though with the final two stocks here, the final two purchases. These are the two largest holdings of these purchases. And coming in at number 4, well, we have what is easily my favorite of the bunch so far. And that is the mighty Amazon, ticker symbol AMZN, which Vanguard only increased by less than 2%. However, that now makes up over $141 billion worth and close to 3% of the entire pie. And yeah, you guys know my feelings on this one. A company that does well over $500 billion in revenue and is still somehow growing at a double-digit rate is just way too good to pass up on. And even though their profits are technically, in the tens of billions of dollars, they're still nothing compared to the size of their sales by comparison, which is why the valuation appears to be rich at first glance. However, once they actually start caring about profits, that valuation I think will come down. I think people will regret not owning the stock. And for it to only be 13% higher than the sector on a PEG ratio and actually 77% cheaper than their 5-year average on PE, I just think Amazon is a sleeper here. I know it sounds crazy, right? But I think it's a bit of a sleeper that people dismiss because of how much the stock has already climbed. But when I just sit back and think about how dominant this company has become here, to the point where I feel like pretty much everyone I know has a Prime membership at this point, and I don't ever see them losing ground there either. I just think that's going to keep climbing because they just add so much value to these memberships with having virtually anything you want and anything you need right at your doorstep within like 1 to 2 days usually, and also at much lower prices than most brick and mortar stores alternatives out there. Plus, you get video streaming, you get music. There's just so much here. And when I look at the convenience of it all, I just think most people are going to continue being willing to pay for Prime. They're not going to get rid of it, I don't think. I think they have a lot of pricing power, actually. And having that giant pool of users, I think is just going to continue to be super valuable to them, not to mention all the other stuff they do, like, the cloud computing, the digital advertising, the investments in EVs and gaming, and even pharmaceuticals. I mean, I just think the genie is out of the bottle at this point, and you're not getting it back in there. Amazon is, in my opinion, too big to fail at this point, and not just that, but it's going to continue to get even larger over time. And most importantly, I think it's going to become very profitable too as they kind of start to dominate the world, as weird as that sounds. But hey, if that's going to happen, why fight it? I think it's a stock that is worth picking up at pretty much any price that it's ever been at. And even at today's higher levels, it's going to get the number 1 ranking from me on this list. It's a stock that I have to have in my portfolio. That's just how I feel about it. Now, purchase number 5, the last one, could potentially give them a challenge here, as they're actually a larger company by market cap now, if you can believe it. And that is, of course, Nvidia, ticker symbol NVDA, which Vanguard chose to increase by another 4% last quarter, bringing the stake up to nearly $200 billion worth. Now, personally, I think Amazon is a much larger, more diversified company that is more worthy of carrying a higher market cap, but Nvidia actually beats them by over $1 trillion and is now the most highly valued company in the entire world, at least at the time of this recording. These numbers kind of change fairly frequently at times, but what's really crazy about all this? You could literally combine both Amazon and Meta, and that would still not be valued as much as Nvidia. It's pretty freaking wild, and it has to do with Nvidia's stock, of course, skyrocketing in recent years. It's climbed by over 3,300% in just the past 5 years alone. Now, that's not to say that there isn't good reason for that climb, as the AI boom has really sent demand for Nvidia's chips soaring right along with their financials, where sales more than doubled last year to over $60 billion, and yet are still expected to nearly double this year as well. And guys, the even bigger story is their profitability, which has 7x'd since 2020 and is still expected to more than double this year as well. It's just mind-blowing the numbers that they're putting up. And because of that, even with the crazy rise in the stock price, the valuation is actually still pretty reasonable at a PEG ratio that's not only 26% cheaper than their 5-year average, but even 22% cheaper than the sector as well. Now, I do think a lot of that is because analysts are super optimistic about their future, but hey, just to have the potential of that, just for analysts to be expecting that of them is pretty crazy. Anyway, you look at how much AI is on the rise, with companies fighting to get their hands on as many of NVIDIA's products and services as they can. And I just think NVIDIA is a solid stock to be invested in long term because of it. However, I just can't bring myself to say that it should be worth more than Amazon and Meta combined. That just feels so wrong to me. So I'm going to have to put NVIDIA right behind Amazon at number 2 and push the rest down one spot to fit it in. But there you have it, guys. Overall, I think most of these stocks here make sense. And there's really not a single one of them on the list that I think is too crazy of a pickup. In fact, I own the top 4 that I ranked. I own them myself, so I can't disagree too much with these choices. I do think they're all a bit rich at the moment, but that's just kind of where we are in terms of the broader market as a whole. It would be very nice to get a bit of a pullback or a correction to get some more attractive prices out there, but who knows when that will actually happen. In the meantime, I do think these stocks are pretty solid long-term investments. Again, I just think they're probably a little rich, I would say, in terms of valuation wise and stuff like that. But anyway, what do you all think? Do you agree with my ranking? Would you make any changes to it? Do you own any of these stocks? Let me know down in the comment section. Thanks again for stopping by, my friends. I hope you are all doing well, and I will catch you in the next one. Thanks for all the support, everyone. Okay, take care. Bye-bye.